Welcome to the Smart Business Revolution.
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 You want a revolution?
You say you want a revolution?
Revolution. The revolution.
It's going on right now.
Welcome to The Revolution, the Smart Business Revolution podcast, where we ask today's most successful entrepreneurs to share the tools and strategies they use to build relationships and connections to grow their revenue. Now, your host for The Revolution, John Corcoran.
All right, welcome everyone. John Corcoran here. I am the host of this show, and you guys know my story. I am a recovering political hack and a recovering lawyer. I spent years working in politics, including as a speechwriter with stints working in the Clinton White House for a California governor, and also working in Silicon Valley for many years, San Francisco Bay Area. 10 years ago, I discovered this medium of podcasting. I've been doing it ever since because I get to talk to all kinds of smart individuals like my guest here today. In over 10 years of hosting this show, I've had the privilege to talk with top CEOs, founders, entrepreneurs of all kinds of companies and organizations, ranging from YPO to EO, Activation Blizzard, Lending Tree, you name it, and all kinds of great relationships that have come from it. And today, I'm really excited. I'm a big fan. I can't say that for every guest that I have, but I am a big fan of this particular individual. His name is John Warrillow. He's the founder of the Value Builder System, which is a cloud-based assessment tool that business owners use to assess their company's scalability. He has helped more than 55,000 business owners improve their company's value by up to 71%. He's also the author of the great book, Built to Sell. You got to read it if you haven't already. Both Fortune and Inc. magazines have recognized the book as one of the best business books. John also wrote The Automatic Customer, Creating a Subscription Business in Any Industry. And he also hosts the great podcast, Built to Sell Radio, where they interview founders about their exit journey. You got to download some of those episodes. They're really just great content. It really does the medium well. And his latest book, John is going to tell us all about it today, The Art of Selling. And really cool to have you on here today, John. I'm really excited about it. Of course, this episode, as always, is brought to you by Rise 25, which helps B2B businesses to get clients, referrals, and strategic partnerships with done-for-you podcasts and content marketing. You can learn more at rise25media.com. John, I'm so excited to talk to you about this here today because I'm a fan of your work. But let's start right with the new book. Like, what inspired that? You've got the podcast, you got the highly acclaimed previous books. Why drag yourself through the hot coals again of putting out another book?
Yeah, I felt like, thank you for having me, by the way, and thank you for the kind introduction. I've done now 300 episodes or roughly that of Built to Sell Radio, where I interview a different entrepreneur every week and say, like, how did you sell your company? What did you do? And what I found is there's a group, it's a small cohort of my guests who seem to perform and punch well above their weight when it comes to selling. And what I mean by that is the multiples they get for their company seem to be disproportionately high relative to the normal.
Yeah.
And so I just tried to figure out, like, what are they doing differently? And I noticed that they sort of had a bit of a playbook.
I have to say, and it's funny when I've listened to some of these episodes where you almost kind of like, there's kind of like pleasant surprise in your voice as you're talking to these people, and you're like, you're just like genuine curiosity. How did you get that multiple? With some of the people you talk to. Yeah.
And I just did an episode like literally 10 minutes ago with a guy who sold a professional services company. So 30 employees, assets, as David Ogilvy said, go up and down the elevator every single night. And typical professional services company might trade at, 4 or 5 times EBITDA. That would be a pretty common multiple. He got 12 times EBITDA without an earnout.
Wow.
And professional services companies, that's the way they sell, right? You get a bit of money up front, but they generally then tie you into a 3 or 5 year earnout where you got to hit these goals along the way. And he got out 12 times, no earnout. And my reaction was, as you just said, wow, how did you do that?
Yeah. Now, one thing that was surprising, an insight from one of your recent podcast episodes, were that businesses, as they cross like an 8-figure threshold, there may be more buyers out there than when they're below that threshold, which was a really interesting revelation for me when I listened to that. Why is that?
It's primarily because private equity companies start to enter the fore when there is at least $1 million of EBITDA. So private equity is this whole legion of buyers who buy businesses, and their general floor minimum is a company with at least $1 million of profit. And so if you're thinking of a company with 10% profit margins, it means that they have about $10 million of annual revenue. It's kind of usually their minimum cut, their clip. And there are literally an army of private equity groups out there who basically buy companies. They try to buy them as low as they can, and they try to flip them downstream. And so while bigger companies have obviously strategic acquirers that are looking to buy them, smaller businesses don't generally have that. But once you clip that 8-figure mark, you can be very attractive to private equity groups.
Okay. And now I apologize. I butchered the title of the book. It's actually The Art of Selling Your Business, not The Art of Selling, The Art of Selling Your Business. And now you mentioned private equity firms, and you also talk on the podcast and in the book about strategic versus financial buyers. And our private equity, they could be either, right? And can you explain the difference between those two different types of buyers and why you should care?
Yeah, for sure. So a private equity group is usually they're what is determined at financial buyer. And so what they're buying is your future stream of profit. And so for them, they're placing a value on your business based on how much profit you expect to make in the future and how reliable those estimates are. So they tend to buy businesses with healthy profit and very predictable profit. So in a carved out niche that they've been in for years, and that they can be, relatively sure that the business is going to continue. Strategic acquirers are buying your business for what it's worth in their hands. And it's usually easier if I give you an example than try to technically explain it. Essentially, your business might be worth more in the hands of a strategic acquirer because of something they're trying to do or something they own. So I interviewed a guy called Jay Steinfeld who built Blinds.com. And Blinds.com was started around the time Jeff Bezos started Amazon. Jay Steinfeld figured Bezos can sell books, I can sell blinds. The only challenge with blinds is they're more complicated, right? You got to measure them, you got to pick them out, you got to install them. And so it took him longer, but after 30 years, he built Blinds.com into a $100 million company. And when he went to sell it, Home Depot was his strategic acquirer. Now, why would Home Depot want to buy blinds? Number one, it was because they were number one in their category, and Home Depot wanted to be number one in blinds. The second reason, though, is hidden, but it's, I think, equally, if not more important. And that is that Home Depot was struggling to get people to buy stuff on their website. Everybody wanted to rock up to a Home Depot store and buy in a store, but Home Depot knows that if they can get people to buy on their website, it's going to be infinitely more profitable for them. And so in buying blinds, they approached Jay to do that because they were like, if we can basically figure out his secret sauce for selling complicated products that need to be installed, and then graft that knowledge onto $90 billion worth of revenue, which is how much revenue they were generating at the time, that company is worth a lot to us. And that's the definition of a strategic one. For Home Depot, the knowledge blinds had was much more valuable in Home Depot's hands because they could spread it out across $9 billion or $90 billion of revenue. So that's the difference between a strategic and a financial. And generally will then garner a higher value for your company, and for that reason. Right.
Now, you've interviewed so many founders on your show who've sold to both strategic and to financial buyers. Do you notice a difference in maybe in terms of success of the ultimate transaction or in happiness of the founder after the fact based on which one they sold to?
Yeah, look, I think private equity groups are challenging in the sense that the deals they structure are generally a majority recapitalization where they're buying a majority ownership in your business, but not all of your business. And so they ask you to carry a percentage of your equity into a new entity. And so it's kind of being half pregnant. Like you've sold your company, but only 70% of it. And so you've got to carry a chunk through. It's enough that it's meaningful that you don't want to walk away from it, but it's also a challenge to manage and operate with a private equity group as an investor. So you're basically being held hostage, or you're in the business, but you're no longer control. And I'm reminded, I did an interview with a woman, Sherry Deutschman is her name, and she's based in Nashville. She built a company where they do billing for hospitals. She built it up, 40 employees, and kind of from scratch, right? And early in her decision making, she decided she was going to share profits with her employees. And she hired a lot of hourly workers, simple jobs to some extent. And she decided that she was going to pay each month a small portion of her profits. And so at the beginning, the checks were like $7, $12, very small. But over time, they started to get more meaningful for her employees. And so by the time she hit 40 employees, Sherry decided to sell, and she sold to a private equity group. Now, that sounds great on the surface, but she rolled some equity in, and the private equity group started to change the business. And one of the things they did very quickly is they said, this profit sharing thing is costing us all this money. We don't need to pay these hourly workers all this money. Let's get rid of it. And Sherry said, no, that's part of our culture. That's what makes us, different as a place to work. And they said, no, but look how much it's costing us. You can see here on the Excel spreadsheet, row number 14, that it's costing us all this money. And lo and behold, they got rid of the profit sharing plan, and it destroyed the culture of the company. When I spoke to Sherry, I think she was from 40. I think there were only like 6 or 7 employees left from that 40 high point. And she left the company. She'd walked away from her role as CEO because it was just devastating for her. And so that's a sad story, but it's, I think, emblematic of some of the problems associated with selling to private equity, because they are financial engineers as opposed to entrepreneurs. And there is a difference.
I hope I'm not conflating different episodes, but I think I remember in that episode, she also told her employees beforehand that she was going to sell and got them involved. So she didn't have to hide it to all of them. She didn't have to, sneak around or anything like that. And she actually incentivized them. And actually there was a wonderful story about after the fact, after she sold, and she was able to share, I think it was 15% of the profit with the employees. But one question I was going to ask related to that is, you don't often hear that. You don't often hear about sellers telling all their team that they're going to sell beforehand. And it's kind of a big thing that they're fearful of a lot of times. So reflect on that, whether that's the right approach or whether you think more founders should tell their team beforehand.
Yeah, it's one of those difficult things where what is morally right is strategically wrong. Meaning, what is morally right is to tell your employees you're thinking of selling. These are the people that you have, or you're indebted to. In many cases, they're friends of yours. They're keepers of your culture, and you feel indebted to them. And so it feels very natural to want to share the news that you're thinking of selling, or that you've signed a letter of intent, or that, blah, blah, blah. Almost always it is a strategic mistake, because when you give leverage to the other side, they use that. And one of the ways you can give leverage to the other side is to tell your employees, because at that point they become motivated to help you sell. Maybe there's some equity in it. They may also get fearful, and that information can be used against you. So look, I think it's almost always a mistake to let your employees know, and it's even a mistake to let an acquirer have a conversation with your employees, because oftentimes acquirers use the veil of an acquisition to actually scoop or recruit your employees. I'm reminded of a story in the book. Actually, it's a private equity group whose name should go unmentioned.
Or maybe they shouldn't.
They approached 80 different companies in the same industry. They were building out a play in this. They were rolling up companies in this industry, and they used a non-binding indication of interest to get business owners excited about selling to them. And so they kind of put together, when I say non-binding, they weren't legally required to fulfill on their commitments, but it was a sort of a 2-page, hey, we're acquiring companies in your industry, love to sit down with you. And they used this veil to interview the executive team of these companies. Well, after 80 different conversations, they made 2 acquisitions, and they systematically went and hired employees from the other 78 companies that they were interviewing, because those companies had opened their kimono too early, right?
Who their best people were. Yeah.
Yeah. Without an NDA, they basically said, yeah, come on in. I want you to meet Bob and Susan. And the private equity group went about basically using that information. So look, I think, long story short, I think you're going to want to tell your employees, but it's almost always a mistake. So
yeah, I have so many things I want to ask you, but we've kind of skipped over one of the foundational pieces, which is the most important question that most founders never answer. They never ask themselves right from the get-go. Share that with all of us.
Yeah, look, I mean, most of the book is very hard technical advice, very specific advice. This is sort of a little bit more kumbaya, a little bit more fluffy, but I think it's very important. And that is that for most entrepreneurs, we are all push and no pull when it comes to selling our business, meaning we're frustrated, we're bored, there's something that's bugging us about our company. And therefore we're like, okay, I want to sell.
And this is the idea of the push versus the pull that you write about and talk about.
Yeah, thanks for reminding, kind of keeping me on track. We're all push, meaning we're basically running away from things in our business. Yet the folks who end up being happiest with their exit tend to be more pull, meaning they tend to be thinking about where they want to go, the book they want to write, the course they want to create, the company they want to start, the charity they want to build, et cetera. And that's sort of I'm sure that's important. It sounds kind of fluffy but it's, I think, very important to get clear on that, because it's one of the reasons I think a lot of entrepreneurs end up regretting their decision to sell, because they've taken away this really meaningful part of who they are, and they haven't filled the void with something else.
You've sold 4 businesses. Where were you in that spectrum when you made each of those sales?
Yeah, I mean, I think not in great shape, to be honest, not where I should have been. I think the one that I got right, it was the last one. I'm a slow learner. My wife and I decided, we had young kids at the time, and we decided that it would be really cool to live abroad. We were living in Toronto, where it's cold 6 months of the year, and we thought, wouldn't it be cool to live somewhere else? And so we decided that we were going to move and pick up our family, put them in a local school, and really kind of burn the ships, as they say, and really dive into a different culture. And so we decided to move to Europe, and that gave us something to focus on. And so when I sold my last company, I was very much deep into the planning for that, the excitement of being over there. Everything's new, culture's new, and that was really important for me to emotionally get beyond the sale of the company, because it was even just physically being in a different environment was important for me.
And one of the chapters you write about the timing of your exit, how to decide when to sell, which I imagine when you have something that's pulling you, like that idea of living abroad, makes it a little more complex, makes it a little harder. So how do you time it?
Yeah, I mean, look, I think one of the biggest mistakes is trying to time it. I think a lot of entrepreneurs, we are opportunists, right? And we're like, okay, I'm gonna sell my company when it reaches maximum value, sales reach an absolute peak. The external market is going well, and that's when I'm going to sell. And the challenge, of course, is that it's very difficult to pinpoint that. And the danger is we ride it over the top. And I write about an example of that in the book. A guy named Rand Fishkin, who built a great company, and I had the opportunity to interview him. And he had a company called Moz, which was SEO software. It did about $5 million in revenue. And Rand had has been told that a software company like his should be worth roughly 4 times top line revenue. And he was growing quickly. He was at 5, but he expected to be at 10 million in revenue the next year. So in his mind, he was like, we should be kind of worth around $40 million. So he gets a call from a guy named Brian Halligan, who co-founded HubSpot. And Halligan says, look, we see what you're doing with SEO Moz. We want to buy your company. He offered $25 million of cash and HubSpot stock. Fishkin, he's got the 40 number in his mind, says, we're thinking more like 40. Halligan says, I can't do it. You're only 5 right now, and walks away. Fishkin says, well, that's okay. I've got lots of ideas, and invests in a bunch of new products. those products mostly struggle. And then Fishkin starts to struggle personally, as he described when I interviewed him. And ultimately, he was removed from his company by the venture capitalists who bought into the business. Now, the venture capitalists, when they invested, used what are called preferred shares, which means that, this as a lawyer, they get a preferred return. And I asked Fishkin, Rand, when I spoke with him, I said, what are those shares worth? And he said, they may not be worth anything, because of the preferred return the VC gets. And I said, wow, what would that offer have been like from HubSpot? And he's like, based on the appreciation in HubSpot stock, it would be worth somewhere between $100 and $200 million. Wow. And I think it's just emblematic of, or illustrative of this idea of riding it over the top. The best time to sell your company is when someone's buying. And when you get a call from like a luminary like Brian Halligan, who offers you 5 times revenue, it's time to pay attention. That's a good offer. Right. And you never know what's around the corner. You never know when the next pandemic hits. And I think that's one of the dangers that we all run into is trying to be a bit too cute when it comes to timing the sale. Yeah. And if you get approached, that from a negotiation perspective, you're in the driver's seat, right? And the opposite is true, meaning if you were the one soliciting a bid, you're now on your back foot a little bit.
And also, so managing your emotions and managing your expectations are kind of inherent in what you just said. And you've got this great story from Built to Sell, which is written as a parable at the very end, if I'm remembering correctly, where the person that you're writing about opens up this envelope that his mentor had him write in the number that he wanted. Can you tell that story?
Yeah, I mean, in Built to Sell, the protagonist is a guy who runs a marketing agency, and very early he's doing about $1 million in revenue, it may be 150 grand in profit, but it's lumpy, cash flow is lumpy. He's being pulled in a million different directions. And his mentor, you're right, this guy named Ted says, "Look, sit down, write down what's the dream number, what's your magic number." And after a couple of glasses of wine, the protagonist writes down $5 million, and it's to him at the time, it's like completely ridiculous number to put down for a company that's generating $1 million and it's a service business and it doesn't make any sense. But he put it in an envelope and he sealed it up and he kind of put it in a desk and just left it there. Years later, the business, after they implement things like productizing, recurring revenue, pulling that owner out of the business does reach a point ultimately when it's worth around that much money. And he gets an offer, which is then rescinded by the acquirer, or I should say dropped. And it's in a technique acquirers often use called retrading. And retrading happens when you agree to a letter of intent, and then ultimately the acquirer reduces that value that they offered in the letter of intent, sometimes for reasons that are less than authentic. And so this happens to this character, Alex, in the book, and he's kind of stomping his fist on the table saying, "Damn it, they promised me X, and now they're only giving me X, minus 20% or whatever it was." And the mentor says to Alex, "Why don't you go get that envelope that's sitting in your desk, open it up." And sure enough, even the reduced amount eclipsed what he dreamt of. And it's just it's a cute little story, or I think it's a cute little story to remind entrepreneurs that we tend to move the goalposts, right? And yet when you reach what we call the freedom point, which is the point where you built enough liquid assets that the sale of your company, it reaches like the business that you built is worth enough that if you sold it, your after-tax proceeds would fund the kind of life that you dream of. And once you reach that point, it's worth asking, do I want to stay on the hamster wheel? Do I want to risk that financial freedom for the next tranche of growth, the next plateau? Because effectively, every day you continue to run your company where it's like 70, 80, 90% of your net worth, you're effectively risking what is freedom for something that you may not actually desire or necessarily find a worthwhile trade-off. So it's something called the freedom point we talk a lot about.
Right. And there was an interesting interview, I don't remember which one it was recently, that I listened to of yours, where one of your guests talked about, oftentimes the EBITDA multiple that people get for the business is just beyond what they would earn in a couple of years. So if it's like a 3 to 4x multiple, then they're going to earn that back in the next couple of years. But if it's 6 or 7, then that is beyond that. So then it becomes more worthwhile for them to sell. Can you talk about that?
Yes and no. I mean, yeah. So sometimes when when somebody gets an offer of 3 times profit, as an example, they're like, why would I bother selling? In 3 years, I'll make this money. I counter that with, number one, you never know what's going down the pike. You never know what the next black swan is going to be.
Yeah. Mm-hmm.
Yeah, exactly. And so 3 times may actually be a great outcome. I'm reminded of a guy named Sean Oshman. I interviewed years ago now. It's still one of the most popular episodes on our show. He built a little IT services company, built it up to, I think it was like $2 or $3 million in revenue. He had decent profits, but nothing crazy. And he decided on his 39th birthday, by his age of 40, he wanted to live on a sailboat. And that he had a vision board, and he decided that he wanted to live on a sailboat. Fair enough. He lives in Denver, and so he's landlocked. He figures sailboat. So he goes and gets a broker, and they sure enough come back with an offer between 2 and 3 times profit. And Oshman decides to take it. And I interviewed Oshman, and again, I'm expecting him to be a little bit disappointed. 2 or 3 is like, it's not a huge life-changing amount of money. And he says, no, I'm happy as a clam. I'm living the life that I've dreamed of, right? I'm living on this sailboat. And so I think it comes back to having a pull factor, having something that's really pulling you forward. And that sense of being on Maslow's hierarchy of needs, having the first rung that you can never fall off of. You built enough wealth that you're not worried about food and shelter for the rest of your life. There's tremendous value in that. So I think, and there's also practically tax efficiencies where you sell your business. If you're making profits of, that's going to be, you're going to have to pay income tax on that. Whereas if you sell your business, there's some ways to structure it that you have either a low tax or even in some cases a no tax liquidity event. So, I think it's short-sighted to say 2 or 3 times, why would I bother selling? I think there's lots of reasons to still sell, even if that's the value that you're able to get.
I have to ask you a nerdy technical question, if you'll oblige me for a second. But in almost every episode, you ask if they valued the business on the basis of a multiple of EBITDA or a multiple of revenue. Can you explain the distinction between the two and why that's important?
Yeah, for sure. So simply put, a multiple of EBITDA is a multiple of your earnings before interest, tax, depreciation, and amortization. In other words, your profit. Multiple of revenue is when you're applying a multiple to your top line revenue, not your bottom line profit. So let's just say you have a company generating $1 million of revenue and it makes $200,000 a year in profit, and you sell for 3 multiple. Well, 3 times 200,000 is $600,000. If you were to sell that same company for 3 multiple of revenue, your sale price would be $3 million. So it's a huge difference in terms of value. And companies that have recurring revenue tend to get much higher valuations, and are oftentimes the ones, when you hear about a multiple of revenue, it's generally recurring revenue businesses, software as a service businesses, but not always. I mean, I'm reminded the guys in the security company business, they have 2 forms of revenue: installation and recurring. Right now, typical acquirer will pay about 75 cents for every dollar of installation revenue and about $2 for every dollar of recurring revenue. So almost 3x more per dollar for recurring. So usually businesses with recurring revenue can often get multiples of revenue, if they're growing fast, et cetera.
We're running a little short on time, so I do want to ask you.
I'm long-winded.
No, I'm enjoying the topic. So I do want to ask you, what are you seeing? We're recording this in January 2021. We're about a year into this pandemic. The types of selling trends you've seen over the last year of observing businesses being sold, probably many at the bottom and the top.
Yeah, in fact, we've actually just done some data analysis on this. So I run something called the Value Builder System, which you mentioned in your intro. We have entrepreneurs come in and they do an intake questionnaire about their company. And we looked at people who completed that questionnaire the 8 months prior to COVID and 8 months during COVID. And we just recently analyzed that data, and 2 things pop. One is that business owners during COVID, those that filled out the completed the questionnaire during COVID, have brought forward their sell-by date by 20%, meaning they're planning to sell their business 20% sooner. The second, arguably more interesting fact is that the appetite to pass their business down to their kids has dropped through the floor. It's gone from like 1 in 5 down to like 11% of business owners. It's dropped precipitously. And in the other direction, the percentage of business owners that plan to sell their business to a third party has gone up. It's now over 60%. And so, I don't know the answer of why that would be. My guess is it's probably just the stress of the last year.
Frustration,
they don't want to impart that on their kids. But we're seeing a lot of activity. And of course, interest rates being so low allows private equity groups in particular to acquire and borrow money to acquire businesses. So it's a very active M&A market right now.
Interesting. As I said, we're running out of time, but I want to wrap things up with 2 questions I always ask. Number one, I'm a big fan of gratitude. So as you look around at other peers of yours, contemporaries who are operating in your space or who you have operated in your space over the years, who do you respect? Who do you admire? Who do you look to and you like the work that they're doing?
I'm a huge fan of Tim Ferriss. I think he's really reinvented himself. I had the chance to write a blog post for him around the time I wrote Built to Sell, and it to this day is it's the single most effective PR thing that we've ever done to sell books. That was back when he was really focused on the 4-hour work week and the idea of building the muse, et cetera. He's done an incredible evolution, and as you probably know, he's done a lot for mental health. He uses psychedelics. His podcast has become this global sensation. And I'm just really, this sounds corny to say I'm proud of Tim. It sounds like I'm his father. I'm certainly not. I'm enamored by, I'm impressed with, and I just think he's done an amazing job of reinventing himself, contributing. He certainly doesn't need to work anymore. He's made lots of money as an angel investor, but he's continuing to serve his listeners. And I think that's really admirable.
It's really amazing all the different entrepreneurs who will say they were inspired by reading his book and that made dramatically different life choices based on that book. So it's definitely had a huge impact in that sense.
Absolutely.
And then, let's pretend we're at an awards banquet, much like the Oscars or the Emmys, and you, John, are receiving an award for lifetime achievement for everything you've done up until this point. And of course, we always thank family and friends, but beyond that, are there any mentors? Are there any business partners? Are there any coaches? Any teachers? Anything like that? And along those lines that you would acknowledge in your remarks?
Yeah, it's funny. I'm not going to let you get away with not letting me thank my old man. So my dad was a company guy. He worked at a big company, and he used to come home at night and talk about what it was like to work for a big company. And sometimes there was a modicum of jealousy about the entrepreneurs that he interacted with in his life, saying, "Oh, wouldn't it be great to be an entrepreneur?" And so he exposed me to entrepreneurship from a young age. In fact, his company was the sponsor of the Entrepreneur Ernst & Young Award, the Entrepreneur of the Year Award. And he invited me to come as his guest to this big ceremony. And he was just like, they were a corporate partner, sponsor. He wasn't an entrepreneur, but he exposed me to these stories. And I just fell in love with the stories. And I used to think about my dad a little bit as like, oh, I wish you hadn't been a corporate guy. Maybe why didn't you be an entrepreneur? But when I actually learned more about his life story, he left England when he was 23 with virtually nothing and picked up and moved to Canada and kind of found a job, found a house, like basically did what entrepreneurs do, like basically invent themselves from nothing into something. And so he took a very entrepreneurial leap, even though he doesn't acknowledge it to this day. But I think in retrospect, he did. And so I'm very deeply grateful for what he did for me. And yeah, there you go. I'm thanking my father.
Great. The Art of Selling Your Business, Winning Strategies and Secret Hacks for Exiting on Top is the name of the book. Value Builder System. Also, where can people go, John, to connect with you and learn more about the work that you do?
Yeah, all roads lead to builttosell.com. So that's where you'll find the podcast. If you're interested, you can subscribe. We'll get you a new episode every week.
Excellent. Thanks so much, John.
Thank you, John.
Thank you for listening to the Smart Business Revolution podcast with John Corcoran. Find out more at smartbusinessrevolution.com. And while you're there, sign up for our email list and join the revolution.
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 And be listening for the next episode of the Smart Business Revolution podcast.